Hey everyone. It has been a while since I last made a video, and I will start by my usual spiel, which is I don't have a script and I don't do any editing. So I publish these or I post these in the original form that I recorded them. So you will have to bear with me as I sometimes bounce around a little bit. Like I said, I don't have a script. So first things first, I made this video or a version of it last night. It was 36 minutes long, and as I re-watched it or parts of it, I decided that it had to be redone because I felt like some of what I was saying gave the impression that perhaps trading is supposed to be easy, and that is obviously not the case. And so what I wanted to do is I'm starting over, and I am starting over with the following message. Trading, like all professions, requires time and effort. It requires education. It requires trial and error. You have to fail before you can succeed. There's no escaping the typical path in trading, as is the case with every other profession. However, I do and have always felt that the trading industry, um, the sort of, I'll call it the educational component, or people that make money on the educational side of trading. Not all of them, obviously. There's a lot of really good teachers out there and good mentors, but quite a few of them, they make a lot of money by overcomplicating what is already complicated. So my message to you is, it isn't easy, but don't make it harder than it needs to be. And I really do believe that success in trading need not be so difficult. And it's not the first time I've said it. I've been saying it for years. I've witnessed firsthand how a timeline can be greatly reduced. A timeline to profitability can be greatly reduced. I've witnessed it, and I've witnessed it with the few people that I have helped and taught. One of them is my son, a teenage son, and then there's a few other people in my life who I've had the great pleasure of being a part of their journey. And I've gotten to see how their learning curve is dramatically shorter than mine. And so, what it has really taught me is that you can, that it doesn't have to be so complicated. And I wrote about this in an interview with Kina at the Trading Resource Hub, which I can put a link to in the comments and in the description in case anyone's interested in reading it. But I really don't believe it needs to be so easy. And um, so I wanted to start with that, and then what I want to do is I want to share a trading methodology that I use along with the few people that are in my very, very tiny trading community. And I'll start by saying that um, there is no easy path to money. Like there's no holy grail in trading, just like there's no holy grail in anything else. Um, I'm gonna share something with you, and it's obviously, I'm not making any promises. I'm not making any future predictions in terms of your performance. There's no guarantees and all that good stuff. However, I do want to show you how we trade and how I trade, um, and perhaps you will find something of value that you can look at and perhaps bring into your own trading journey. So as I've been yakking, you've been sitting here staring at a screen, and this is my 30-minute chart. All right. So anyone who will listen to me, I am always happy to share that there are only two indicators in trading that are truly real time, and that is price and volume. Every single other indicator is lagging in nature. And And that doesn't mean that lagging indicators or indicators that are comprised of um, data from multiple data points is not useful. That's not what I'm saying. What I am saying, though, is that as a trader, you really do need to understand that the only two real-time data points on your chart or on your screen is price, as expressed in a candlestick or a line or a monkey bar, whatever it is that you use, but it's price and it's volume. Okay. So the way we trade, I'm constantly, I'm forever trying to dumb it down because I personally want to be making as few decisions as possible during the course of my workday. Um, so in front of you, what you see here is you have price expressed as a candlestick, you have volume, and the horizontal lines that you're seeing it's every 50-point increments. So I refer to those as the 50s and the hundreds. Okay, so we have 21,950, 21,900, 850, 800, and so on. All right. And the reason that those lines, those horizontal lines are there is that, and this is specific to the NQ because I am not trading equities anymore. I'm really focused on NASDAQ futures, so the NQ and the MNQ. Um, but so these horizontal lines, for example, if you were to extrapolate that and look at equities, I haven't done the research, but I would think that if you moved it to a ticker that is like you know in the $100 to $200 range, I would think that you probably would see price reacting in dollar increments or $5 increments. Anyways, that's for you to look at if you're trading equities. But in the context of futures, specifically the NQ, what I find is that price does react around the 50s and the hundreds. And I don't know if that's algorithmically driven or if it's just human nature, whole numbers, whatever it is, you can see that price. You can see that price frequently will react and bounce, support and reject um, at at these levels. And whatever the reason is, it doesn't really matter what the reason is, but it does it. And I've I've seen it too much for it to be a coincidence. And so I have these lines on the charts because I will sometimes use them as an exit target. So if I'm short, um, you know, I will look to exit perhaps at 100 level because 100 level tends to be important. So I keep those on the charts. Um, the yellow lines that you're seeing are the previous day high and low. It's as simple as that. I just want to know where price is in the current session in relation to the prior day high and low. Okay, so you can tell like the day prior here, we had a massive range. All right, very, very big range. And that's expressed here. So, and then it very quickly allows me, if I zoom out a little bit, I can very, oops, sorry, I can very quickly, I can see a very expansive range, and then I can see the range tightening a little bit. So I just like to see how price is reacting around these levels, because something else that's important is I subscribe to the idea that a level below is demand until proven otherwise, and a level above is supply until proven otherwise. Another way of saying that is a level below is support until proven otherwise, and a level above is resistance until proven otherwise. And so, for example, a day like this day, this is the prior day high, this is the prior day low, and you can see that the prior day high held. All right, so this prior day high was overhead supply or resistance until proven otherwise. And that means that if I was long here, I would be exiting here because it has not been proven that this line, that this level, that this supply zone um, was broken. So I think that's it works very well for me. It's a premise that keeps me out of trouble, and it's a premise that keeps me from getting caught in rejections if I'm trying to go long, and support if I'm trying to go short. Like I will not long into supply and I will not short into demand. Okay, so that's what those yellow lines are for. And then the white lines are simply the high, or sorry, the high and the low of the overnight session for the current session. Okay, these only appear in the current day. It's just the high and low. When I get up or when I get to my desk at around 6:45 Eastern Standard Time, I just like to know where we are in relation to the Globex session, so that the 1800 hours Eastern Standard Time until 9:30 a.m. Eastern Standard Time. I like to know, I like to know where we are in relation to those levels. That doesn't necessarily mean that I trade off of them, but I want to know where we are, just in terms of strength, weakness, that kind of thing. And then there's one last thing on this chart, which is the only indicator that I use, which is lagging in nature, which is this, I think it's called magenta. I'm not sure, I'm not good with colors, but this line here is the 20 simple moving average, and I'm on a 30-minute chart. Okay, and really what that's doing for me is it's an overall indicator of general bias, with the idea being that price that closes above and holds above is bullish, and price that closes below it and holds below it is bearish. And I use it, that's what I use it for, a general sense of bias and trend. Um, you know, so um, and that's it. That is everything that you're going to see on my chart. And now I want to get into the specifics of what what we focus on. I would say for me personally, it's not going to be the same for each individual in our tiny little group, but for on my side, this probably accounts for 95% of my trades. And this is what we call the 30 min BB. Okay, and that stands for 30-minute body break. All right, so um, that's what this is what my edge is, and by edge I mean my setup, my system, whatever you want to call it. All right, so it's very straightforward, and the reason it's done on a 30-minute chart is that I want to be taking trades that have the highest probability of being in the money right away. I don't like taking trades where the price just sort of hangs around my entry for an hour before deciding which way it's going to go. I want to be I would prefer to be patient in my executions. And then when I do execute, I am in the money very quickly. That doesn't mean that they all work, obviously. This edge has a approximately 72% win rate, which means that, probably three out of 10 trades that you take are going to go against you. So, and that is assuming that you're patient enough to stay out of sideways consolidations and things like that. So, in a nutshell, what this is this is a 30-minute chart, and we are looking to take body breaks, but we are looking for confirmation of directional bias, meaning that we are waiting for confirmation. We are waiting for the price action to tell us as best as it can which direction we should be trading in. And the way we do that is we are always looking for a color bar to close in the direction that we think we're going to trade before we get involved. Okay. So in the case of this chart right here, I mean, this is a very structurally, it's a beautiful chart, right? It's just a perfect V, upside down V. But the entry would not have been, the entry would have been right here, okay? Because I'm waiting for a color bar to close before I get involved. So this is where my trade would have been. because I would have had a white candle close. So, by the way, I use black and white candles instead of green and red. I find green and red, they're much more, they're just much more emotionally turbulent colors, whereas black and white and a gray, a monochrome background is I find just very chill. It's very relaxed. So, uh, white is going to be green for those of you who are using colored candles. Black is going to be red, okay, which is pretty straightforward. So I would be looking to watch and see how this candle closes. And then on the next candle, I would be looking for it to set a wick. I don't have a prescribed or a minimum amount for the wick, but I would be looking for it to retrace a tiny little bit. Um, and then I would look to get involved at the re-break of the body. Okay, and so that when I say the body, what I'm referring to is in the case of a white candle, I'm referring to the close is the upper body and the open is the lower body, and it's the reverse for the red candle, okay, or the black candle, okay? So we have our open up here and we have our close down here. So in the case of going long, I would be looking to take an entry at the break above the prior close. And um, and my stop would be located below the wick. And we have two options. Like the price action on Friday was very strong directionally. So it basically price opened and almost immediately went, as you can see in these candles. Now, more frequently, what you'll get is this is a bit more common, okay, where price will open, pump up a little bit, and in this case, it pumped up 916. It pumped up about 10 or 12 points and then fell back down. So you have the option of in very strong directional movement, meaning you have very strong momentum behind the price movement. You can take larger size and use much tighter risk. If price is bouncing around a little bit, it's more volatile, then you could use a sort of set wider risk and smaller size. But that's it in a nutshell. We wait for a color to close on a 30-minute chart, and we get involved on a continuation in the direction that closed prior. And it's the same thing here. This would not have been a short. I'm never trying to pick tops. All right, I just trying to catch a falling knife to the bottom or a shooting star to the top, trying to reverse those is just it's a recipe for disaster. So in this particular case, we would have waited for a reverse color to close, and this would have been our short entry right here. All right, and this some people will say, well, you could have taken the reject of 950, or you could have gotten it as it came down through here. Sure, I could have, but I have a much lower edge in that particular case. And I prefer to come in here with more certainty. It allows me to take a larger size position, even if I'm taking it for a smaller amount of money. So that is it in a nutshell. Again, so let's hear. We then had a reversal bar. I would have waited for this to close, and we would have gotten involved here. And then and then each 30 minutes for us is a potential new trade. So people ask, well, when do you get out? I tend to get out within the 30-minute candle because I am focused on paying myself. My job as a trader is not to have perfect execution charts, right? I am not looking to pick bottoms and I'm not looking to pick tops, nor am I looking to take 100% of the measured move. I am looking to show up every day, act on my edge without reservation or hesitation, as Mark Douglas says in his book, um, and pay myself. That is what my job is. My job is that's my sole job is to make money. It's to generate profit by executing an edge. It's as simple as that. There is no other metric in trading that matters. Can you refine the amount that you get paid? 100%. Should you be tracking your data and knowing if your MAE and your MAE are where they need to be? Sure. Do you want to know what your win rate is and your your return rate and risk to reward and all that kind of stuff? Absolutely. But the point is that before all of that, your job fundamentally at the bottom of at the end of the day is to pay yourself. Okay. The number of people that show up in the market and take a trade and have it turn into a loser or a break even, it's huge because there's hope involved. When I take a trade, I am not hoping. I know where my exit is. I know where my entry is because my system tells me exactly where my entry is. And I know exactly where my exit is. Okay. I always know where I'm exiting. So in strong directional movement, I may, I may sit in the trade for longer, right? So if I don't have a looking left level at which to target my exit, I will ride the momentum. I will trade the momentum. And when I feel like the momentum is going out of the trade, then I will exit. And so that's something that brings me to something. It's really important that having a system, having an edge that you trade does not absolve you of the need to hone your expertise in the ability to read a chart. You need to be able to read momentum in a chart. Price and volume are so important when taken together. It's not just about the chart. If you look at this chart, okay, if you look at the session for Friday's session, it starts at 1800 hours and it goes all the way until 1700 hours. All right, it's a 23 hour long session in the Nasdaq futures market, but it's not all created equally. You've got more volume here than you do here. You have more volume here than you do during these hours. And look where volume starts to step in 7 o'clock in the morning and then really step in. Okay. You've got to ask yourself, where do you want to be involved? Where do you want to be trading? Now, clearly, if you have a schedule that does not allow you to trade during certain times of the day, then you have to schedule yourself, accordingly. But if you, especially for those people who are looking to trade full time, um, you really have to decide, do you want to be taking trades when there's low volume, or do you want to be taking trades when there's high volume, high liquidity, strong momentum? So price on its own is one thing, but price and volume together are so important. And you can see the price action, you can see the momentum. Pay attention to how candles are forming. You can watch the bid ask on your platform. So I have bid ask up in here. I have a bid ask on my right hand screen, which you can't see, but I do. And you also have, you can just tell by, I can tell by the way that the candle is forming, by how the price is moving, how strong it is, and when the power starts to leak out of it. So I really recommend that if you're focusing time and energy, that you make sure that you're also including getting a good sense of how to gauge momentum, which is really what it comes down to. And it just takes practice. You can see it in the tape, um, which is the time and sales print, which is, this is the time. Well, there's not going to be anything there because we're on Saturday, but the time and sales, or what the tape is showing you, the actual orders that have gone through with their size, and the color of it is going to change based on whether or not it's been executed at the bid or the ask, or split in the middle. And just start paying close attention to that. So Back to the back to this 30-minute BB. Um, yeah, I think that. Hold on just a second. Why is this not? Hold on. Okay, so back to the strategy. And so it's really as simple as that. You have a very specific entry, which, with the exception of a couple nuances, which I'll get into after, requires that a same color bar close before you get involved. Okay, and that takes a lot of the guessing out. It removes a lot of the chop that just can kill accounts, and it also ruins your mental capacity. If you're trading in chop, I mean, you can sit there and take 10 losing trades, no problem, and then your mental capital for the day is completely done. And that's when emotion steps in and people start to go on tilt and they blow accounts. All right. So you want to wait for the bar to close, take an entry, and then your exit, I always look left. Okay. So I'm always going to look left. Now, in the case of Friday, when I looked left, I would have been looking to see where prior day highs and lows were. Okay. And that we could see that if you look left, because price tends to revisit these levels, and as it moves through them, it continues to revisit. So, 950 would have been a good bet. Um, but I leave that to you. Everyone is different. Um, you know, I always have an exit. Do I leave money on the table? 100%. Always. Almost every trade, I leave money on the table because I don't have a crystal ball and it's impossible for me to know where price is going to go to. So the only two things that I can control are my risk and paying myself, right? And I think it's important to note that in the futures market, don't if you are trading futures or equities for whatever it is, and every trade you take, you think it's going to go to the moon or the reverse for a short, that's a problem because you're trading based on hope. And really, hope has absolutely no place in a data driven profession. You should not be hoping. You should be paying yourself and being happy with the fact that you executed a trade, managed your risk and paid yourself. I don't care what price does after I get out. Okay? I don't care. I don't have any FOMO. I don't feel badly. I don't beat myself up because I know that at the start of the next candle, I have an opportunity for another trade. Like, it's as simple as that. I only want to be taking trades and paying myself. That's all I want to be doing. So, um, okay, so color bar changes, entry, the exit, you know, you look left, right? So here's an example. This short right here, if okay, this short right here, my exit would have been, I would have looked left and said, okay, well, where's the next logical area of demand? It's going to be right there, or it's going to be at the 850 level. That's what it would have been for me. Was that early? 100%. Now on Friday, there was macro news. Okay, we had big news come out that uh, the U.S. government is levying tariffs, punitive tariffs against Canada, Mexico, and China. And it was when that news came out at 13:21 hours New York time that the market started to sell off. In that particular case, because the tape was so heavy, all right, the bid ask was so heavy, and what I mean by that, the momentum, the volume to the downside was so overwhelmingly heavy and obvious that I would not have come out here. I would have held my position. Okay, Friday was a day which I absolutely missed. I was in a meeting, and my meeting started uh, as this happened. I remember standing in the in a boardroom, waiting for the person that I was meeting with, and it happened just as we were about to shake hands. So I missed this, but if I had been in it, this is a day where, with that kind of momentum and that kind of macro news, you aren't coming out. You're just adding. on each successive trade opportunity and moving your stop down as you go, your risk down as you go. But on a normal day, I would have come out here or I would have come out at the 50. Was it too soon? Sure, but that's just the way it goes, right? And then I would have re-entered for another order here, and I would have come out here because I had a very clear demand level at the prior day high. Um, and then I would have done the exact same thing, and my exit would have been probably right about there because I would have looked left and said, okay, well, what is our next logical area of demand? Is it the right way of doing it? I don't know. All I can tell you is that I pay myself regularly because for me, trading is a job and I need to show up every day and pay myself. There are other traders who, they trade and hold much longer. There are traders that hold for 4 seconds. You have to do what works for you. So what I'm showing you here is I'm showing you a very clear setup that has an edge for the entries, and I leave it to you to figure out where you want to come out. Okay. And that's about it. That's the sort of general that's the general theory. It's very simple. Like this is not complicated at all. Um, Now, I mentioned before there's a few nuances that will sometimes have you take a trade without waiting for a color bar change. Okay, so one of them would be we look for torpedoes. So, for example, not torpedoes, sorry, a doji. Okay, so small-bodied candles, dojis that come at the end or at the top or bottom of a sustained move, those have me paying attention. So this is a trade where I would have watched to take a short right here. Sorry, just let me change the. So this is a trade where I would have gone short despite the fact that I didn't have a color bar of the same color because of the fact that we had this move and then we had a small candle. We had a bigger measured move in the preceding candles, and then it just wasn't pushing ahead. And it was also where to go? It was rejecting at a prior day level. Okay. Yeah, it was rejecting at a prior day high. So I would say to myself, okay, we've come up to a supply level. Remember, a level above is resistance until proven otherwise, or supply, depending on how you term it. And a level below is demand or support until proven otherwise. So for me, this would have been a legitimate short without the prior bar closing black. All right, so that's one example. Again, here we have a sustained move, and then we have a small reversal candle. So those are typically where I will not wait. And I guess another situation could be a situation like this where price has a massive push up and then just fails back down through the breakout level. This is something that I would probably take a short on the system because this candle and the open of the new candle would be a clear indication to me that price what it did was it swept prior day highs and Globex highs and then failed. It just was not able to continue. So this to me is a legitimate short, despite the fact that the prior bar is white and not black. Um, so it's a system. It's an approach to trading that as you trade it, you'll make it. Well, if you decide that you want to try it, you'll make it your own. And there will be certain things that you will see that I haven't. There'll be certain things that you want to do that I don't, and so on and so forth. Again, you make it your own. I'm just sharing it with you to give you a sense of the fact that trading just does not need to be so complicated. All right. Um, and something else that I wanted to mention is the the best gift that you can give yourself is the gift of learning how to trade a naked chart. Okay, so I'm just going to take off all this kind of stuff. All right. The best gift, and I have said this 100 times, the best gift that you can give yourself is learning how to trade a naked chart. All right. That is why I have so much respect and admiration for Tom Hugard, because Tom Hugard he's the king of trading a naked chart. And he's really demonstrated that you don't need very much on your chart to make money, right? And I think that all new traders, I've said this in other videos and I've said it in articles and interviews, um, every single trader should start learning how to trade a naked chart. And that just means learning how to trade structure and volume. That for me that's the holy grail, because if you can trade a naked chart, um, you're golden. You're not reliant on 10 million indicators sitting on your screen. Like, don't forget, the brain is only capable of so much decision making, right? Decision fatigue in any profession is a real thing. In trading, it is multiplied by 100-fold. You're making decisions in the moment, dozens, if not hundreds of times a day. Your brain is having to analyze what's in front of you. So the less that's on your screen, the better. And the fewer decisions that you're making, the more focused you are and the more present you are to opportunities that present themselves. I mean, imagine trying to decipher, 25 different indicators on your screen versus this. I mean, the whole expression paralysis by analysis, that's where that comes from. This is very straightforward, right? I have the opportunity to place a trade every 30 minutes. So, and there's really not much on my screen. I have the price levels marked out on the horizontal grid, but really that's about it. I don't have to interpret those. It's just a line there. I know that it's 650 and 700 and 750 and so on and so forth, right? Um, so I really do preach that people learn how to trade a naked chart. And this 30-minute body break with confirmation candle is pretty straightforward. I mean, you can describe it pretty quick. I've probably taken much longer because I've been talking about a few other things, but it is pretty straightforward. So I think that I think that's about it. And like I said, if you've got questions, you can post them in the comments. And I have no problem giving my email out. I just don't put it online because I'm worried that bots are going to pick it up and I'm going to wind up with 1,000 spam emails a day. But my email is pretty straightforward. It is dmactrades. It's the same as my username. So it's dmactrades@gmail.com. DMACTRADES@gmail.com. Or just post something in the comments. And if I can help, I'm happy to do it. If you think of something that, if you have a suggestion, if you see something that I'm not seeing, super cool. Just reach out. I'd love to hear it. So I'll leave it at that, and with a reminder to pay yourself. Okay? Don't try and be a perfectionist. Don't try and be smart. The market is way smarter than all of us, and ultimately, if you're going to be putting the time and energy and investment into building trading as a skill set, whether you use it as a part-time basis or on a full-time basis, you want to be paid. So pay yourself. If you're taking trades with good entries and you're in the money, pay yourself. And as time goes on and you demonstrate consistency, then you will figure out how to take more and more money from the measured move that is presented to you. And that is, I'll do another video on MAE and MFE. So MAE is maximum adverse excursion, MAE, maximum adverse excursion, and MFE is maximum favorable excursion. The MAE is the data, it's your stats and your data specific to your stop loss. Are you using a stop loss that's accurate, or is it too wide or too narrow? And your MFE relates to your exits. Are you getting out too soon, too late, in relation to the move of the trade? So, and even if you don't start trading this, I recommend just at the end of each day, put a 30-minute chart up and mark it up. Mark it up with the long entries and the short entries as you see them based on what I've described to you, and keep a log of that. And you'll start to notice a pattern. You'll start to say, hey, hold on a second here. Okay, well, there was 6 trades on this day, and there was 7 trades on that day, and 8 trades on that day, and 2 on this day. You'll start to see the edge, and it'll give you some confidence to try and to take a stab at it. So I will leave it at that. I will wish you a fantastic day, and thanks for watching.